A very good morning, good afternoon, and good evening to everyone tuning in. My name is Jun Yuan, and I am a full-time retail investor and the founder of the investment blog, The Singaporean Investor. In collaboration with AlphaInvest, we are producing a corporate highlight video series where we engage representatives from various Singapore-listed companies. The objective is to help fellow Singaporean investors gain deeper insights into these companies so they can make more informed investment decisions. It is my greatest pleasure and honor to welcome our guest for today, Mr. Gauri Shankar Nagabhushanam from CapitaLand India Trust, or CLINT for short. Listed on the Singapore Exchange in August 2007, CLINT is Asia's first Indian property trust. Its diversified portfolio comprises IT business parks, industrial facilities, logistics parks, as well as data center developments across key Indian cities. For Singaporean investors seeking geographical diversification and exposure to the fast-growing Indian economy, CLINT is certainly a business trust that's worth taking a closer look at. In today's corporate highlight session, Gauri will be sharing with us an overview of CLINT's latest financial results for the second half, as well as for the full year ended 31st December 2025. This will be followed by a short Q&A session, where he will address questions gathered from the investor community across various investment forums, including Investing Note and InvestSG. Without further ado, I will now hand over the session to you, Gauri.
Thank you, Jin Yuan, and welcome to everyone. It's a pleasure to use this forum, this opportunity to reach out to you and talk to you about CapitaLand India Trust, CLINT, as we call ourselves. We have been listed in SGX since 2007. We were the first of its kind for Indian assets anywhere globally. Even today, we are among the very few listed opportunities if you want to get exposure to India through well-developed markets such as in Singapore. Without much further ado, I'll quickly jump into the highlights for 2025. And subsequent to that, happy to take questions and try to clarify as much as I can on the questions that the community members have posted to us. 2025 has been a really good year. Our DPU was up year on year, second half of the year compared to second half of 2024 by almost 22%. Not just that, if you take the calendar year 2025 as well, DPU for the year was 7.87 cents, which is almost 15% increase year on year compared to 2024. This came about from a mix of various engines that fired for us. The first was operationally, we became more efficient. We were able to squeeze costs. We were able to churn tenants, and the rental reversion was quite steep at about 21%. This meant that the cash flows that the operating assets were generating was substantially higher than before. We also had a few assets which had just about been acquired, maturing and contributing more to the bottom line. Not just that, we entered into a restructuring of our debt. We actively entered into the restructuring process, mainly from a risk perspective, which is trying to get a natural hedge for the against the INR depreciation. As a part of that, we were able to also, as in the future slides, I'll be able to explain it further, to get a lot of benefit from withholding tax savings and better tax shield effects, which again contributed to the bottom line. So these are some of the aspects which helped us do 2025 much, much better than what we projected. We expect this to continue. We have had some fantastic results in terms of signings of leasings, not just in our business parks, but also in our data center portfolio. 55%, roughly 55% of our data center portfolio is pre-leased to hyperscalers. The first phase of it is going live. We do expect the first phase to get fully taken up by the second quarter of this year, and the full contribution to come through sometime in the third or fourth quarter of this year. In terms of valuation as well, we have been able to maintain, despite the depreciation of the currency, we have been able to maintain a stable NAV for our unit holders. Our gearing, which was hovering higher than 40%, is again better controlled. As you're aware, we've announced a part divestment of our DC portfolio, about 20.2%. The SPA has been signed end of December. We expect the closing to happen sometime later in February. And when those cash flows come in, the gearing should become even more stronger. The debt cost is about 5.6%, slightly better than before. But I'll again explain why community members should not just look at the cost of debt, the headline cost of debt, because there is a lot that is available that needs to be assessed in terms of our effective tax rate, with which you'll be able to arrive at a better assessment of the prospects that CLINT has. This is something which CLINT has been trying to work hard. The total 10-year growth in terms of the DPU has been 4% in terms of Sing dollar returns. We do as management, our intent, our target is to get something in the range of 6 to 7 to 8% DPU growth consistently. Something which we have realized is that our DPU growth has not been secular, it has not been linear. We want to make it as linear as possible so that it becomes much more predictable for the investing community and for them to assess our units. So that is something which we are striving. We want to do that largely through organic growth, not through some financial engineering or not through purely from divestment gains, etc. We want to grow organically, and given the growth prospects that are there in India, given the fantastic pipeline that we have, and given that we have largely solved for the capex, the sources of capital for funding our capex, we think the next 2 to 3 years are going to be years of a real solid growth, which should benefit unit holders quite significantly. At the beginning of 2025, questions were posed of us in terms of what is our strategy for 2025, and I dwelt upon it at the AGM last year, and we are quite happy to say that most of that we sort of set ourselves as targets, we have been able to achieve most of it, if not all of it. We started out with a simple premise that the focus is going to be on DPU growth, and to do that we need to have a very strong portfolio which is highly efficient. We were able to deliver strong results from an operating efficiency perspective. So in terms of rental reversions, which is one of the benchmarks, in terms of NPA margins, we were clocking in the 74% range. We were able to get to about 75, close to 70-80 bips improvement in NPA margin. We expect to continue that journey further as well. We have been able to sign some marquee tenants in some of our assets. So operationally, we did as well as we wanted to do. For the first time in the history of CLINT, we have never actually divested an asset before. The pipeline was very strong. So in 2024 itself, we established our growth pipeline, but a lot of questions were asked about how are you going to fund the growth pipeline? Are you going to raise more debt, busting your gearing, or are you going to come back and raise more equity, which means your dividend is always going to be under pressure? We did clearly articulate that is not a strategy. We are going to look at unlocking value of assets that we already own and use that proceeds to sort of recycle into more accretive projects. So we picked up one of our more challenging assets, which is Cybervale. Cyberpearl is a partly owned asset. We held only about 81% of the asset. 19% was with a bunch of retail investors. And Cybervale was an office property, but within an industrial district where the traction hasn't been there for office assets. We picked up the more two challenging assets and we divested at values which were at a premium to our NAV. Therefore, we established that what NAV we carry in our books is actually realizable NAV. We also established the same by doing the divestment or signing the divestment of the data center portfolio. We divested that at close to 14% increment to what the year-end NAV was for that asset. So again, we established that our NAV is actually NAV that is realizable when we go and sell it in the market. We will realize better values than what we are carrying in our books. We also signed a forward purchase program, increasing our growth pipeline. So it is not just divestment. We are also looking to continue our forward purchase program, our marquee forward purchase program. And not just that, we are also looking at development or redevelopment of assets within our own portfolio. So the yields that we generate in assets that we develop on our own or we develop within our portfolio generally is in the mid-teens. We clock about anywhere between 14 to 16% on those, as against assets we purchase in the forward purchase program, which we clock closer to the 10% mark. And if you compare that, what is the going in cap rate for assets that you acquire in the market today? It's about around 8%. So our forward purchase program gives us assets at least a 15 to 20% discount to market price. And our redevelopment actually give it to you at an even bigger discount. The value that you're able to accrue from these assets is even significantly higher. And like I mentioned before, we wanted to optimize the capital structure by onshoring a lot of debt. We have been able to do that. We also tapped into, for the first time, perpetuals, showing that we have one more lever to raise capital. We did our first offshore bond issuances in Singapore. We did our first onshore bond issuance in India. So we checked a lot of boxes in terms of what we wanted to do in 2025. And the strategy is quite simple. There's nothing fundamentally something fancy that we are doing. These are very, very basic stuff. We believe by just doing the basic stuff in a growing market, we will be able to achieve phenomenal results. And that's what we have been able to showcase in 2025. This is just a little bit more detail on the divestment of the DC portfolio. Like I said, we divested this asset at almost a 14% premium to the independent valuation that was done for the end of the year NAV calculation. The two reasons why we wanted to do this was, the first most important, when the NAV uplift happened in end of 2024, the unit price did not react, which we took it as an indication that the market did not really believe that the DC NAV is actually realizable NAV. By doing this divestment at a premium to that, we have established that the NAV that we carry, the DC portfolio, is actually realizable NAV. And in many instances, we can do better than what we are carrying it in our books at. And number two, we also wanted to achieve financial closure for the data center portfolio CapEx. There was a debt or an equity overhang, depending on which one you thought we would tap to fund the CapEx. It's very, very profitable business, especially considering the steep valuations that the data centers are getting. We have 55% of our data center portfolio is already pre-leased to one of the best hyperscalers there is in the market. So we were able to kind of get financial closure by bringing in a minority investor. The capital that we raised from that divestment will get recycled back into the data center balance CapEx. So we don't need to essentially come back to the equity market to fund the data center portfolio going forward. By and large, it is the debt capital that is there for the projects for construction, and the equity, the capital that we get from the 20% divestment should more or less fulfill the capital requirement for data center portfolio. This is something which is very important, and it's a bit intuitive, not really understood well. If you look at historically, we used to raise debt capital in Singapore, convert it into INR through cross-currency swap and fund them through shareholder loans into India, and then that used to go and do the construction or the forward purchase funding or the acquisition funding. This was beneficial because the all-in cost of a fully swapped loan into INR used to be around the 6% mark. And when you compare to the onshore loan in India to make an acquisition or to do for construction financing, it used to be around the 9% mark. You had a 300 basis points delta, which was there. Over the course of the last few years, things have changed. Interest rates in India have dropped quite significantly. And the cost of debt in Singapore effectively has increased. So the delta today is pretty much non-existent. Whether you raise in Singapore, do a cross-currency swap, or you raise in India, the cost of funding is more or less in the same ballpark, like around 7.25 to 7.5% per annum. But by onshoring, we achieve two goals. One, you have a natural hedge, INR receivable and an INR liability, natural hedge, so currency fluctuations don't impact. But two things that that really benefit the unit holder is that when we used to raise money in Singapore and pump it into India through shareholder loans, we used to actually had to pay a 15% withholding tax, with respect to this particular asset that we refinance. And the withholding tax can range from 5 to 15%, most averaging around 10%. When we actually do the refinancing of that foreign shareholder loan, offshore shareholder loan in India, the withholding tax falls away. So what is a 15% leakage for us becomes zero, which is a net benefit of $2 million in this particular case. Similarly, this was a stabilized income producing property, but because India has certain capital controls, when a foreign investment comes in through a shareholder loan, you cannot set off the interest expense of that loan fully against your income. There was a limit of 30% of EBITDA that can be set off against income. So there was a lot of income for which we ended up paying a higher tax amount than what we would otherwise have done. So by onshoring the loan, the local interest expense doesn't have those limits. So you can deduct the local interest cost fully against your income of the asset, and your tax shield effects are fully priced in. That benefit is another $2.5 million. So effectively, close to $4.5 million of actual cash impact could be felt despite your headline numbers being the same. So if you look at our interest cost, it will be similar, 5.6, 5.7 between last year and this year. But going forward, we'll be saving almost $4.5 million, of which $4 million will be distributable to unit holders, which is actually a real accretive income that they're going to have. This is just a test case. This doesn't mean that for every $130 million that we onshore, we'll have a $4 million of DPU increment. It depends on case by case basis. Now, what is the withholding tax? Like I said, most of the other assets have a 10% withholding tax. Some of the assets are newer and may have carry forward tax losses or may have depreciation, which is reducing the taxable income. So on a case by case basis, it is going to be accretive. Is it going to be 4% accretive? Is it going to be 1% accretive? Is going to be case by case. But all in all, my request is don't just look at the headline number, look at the effective tax rate as well. We have been able to reduce the effective tax rate from about 30% to 27% last year. And our endeavor would be to keep continuing to reduce that effective tax rate. So along with the interest cost, headline number, also look at our effective tax rate to see what the real benefit that is getting accrued by onshoring the loans. Growth strategy, again, is quite simple. We will continue to maintain the focus that we already had on those four pillars, which is strengthening the portfolio through better and more efficient operations. Continue to keep pushing that NPI margin from 75 to 76 to 77. Focus on optimizing the capital structure further, both from a DPU perspective and also from a risk perspective, currency risk perspective. Continue to focus on forward purchase programs, try to build that pipeline so that we have good interest income coming in from when we are funding the construction cost, and we have a pipeline of assets which we can acquire at least a 15 to 20% discount to fair market value. And also look at strengthening our portfolio by shedding assets which we believe have kind of matured and don't have much of an upside, where the rental rates are not going to have higher reversions, or we see some other risks coming in. We would want to use this opportunity to shed some of those assets and continue to build much more stronger defensive, focused assets, particularly in the markets of Bangalore, Hyderabad, and in Mumbai. Our growth pipeline continues to be strong. We have 7 million plus of forward purchase program, which we can buy, like I said, at least about a 15% discount to market price. We are developing close to 1.9 million square feet of our own assets. We have a land bank where we can develop another 3.7 million square feet. the data center is playing out quite well. So overall, we are maintaining the same focus that we had in 2025. A lot of the assets which were under development are continuing to mature and are on a phased manner coming into income producing phase of their life cycle. So thanks to all the unit holders so far for holding the patience in the past when we were having much more developmental exposure. We will continue to focus on growth. Like I've maintained this multiple times and mentioned it to many unit holders before, both institutional and retail. We differentiate ourselves from the S-REIT universe by focusing on growth. We are a growth stock. We want to be among the S-REIT stocks, we want to be the growth stock. And in the larger growth universe, we want to be a stable S-REIT unit. So that is the strategy that we have. The management is absolutely focused on strengthening the portfolio, giving stable returns, and also giving predictable growth. That is the endeavor we all want to do. And so far, touch wood, things are going according to plan. The industry is doing very well in India. The Indian economy is doing quite well. There are, of course, risk factors, currency being one of them, geopolitics being other. Notwithstanding that, whatever is within our own capacity, we are trying to squeeze every single penny out of these assets as much as we can. With that, I would like to conclude my brief discussion on our results of 2025. Junyuan, if I could throw this back to you. Happy to take any questions that you might have for us or any other clarification that you might have.
Thank you so much to you, Gauri, for the really, really insightful presentation on CLINT's latest second half and full year results for the financial year ended 31st December 2025. So now let us move into the Q&A session. There are a number of questions submitted by the community members, and let us go into them one by one. The first question is about a gradual decline in CLINT's committed occupancy since the fourth quarter of the financial year 2024, which was at 95%, down to 91% in the fourth quarter of the financial year 2025. The community member wanted to know what contributed to this trend, along with measures being implemented in the coming quarters to stabilize and improve the business trust occupancy levels once again.
Thank you very much. I do need to concede that we would have, as management, wanted the committed occupancy to close slightly stronger than where it is. We were targeting something which is closer to 93% plus, but it ended at 91%. There are some valid reasons for it. One of the reasons is actually rental reversion itself. We wanted to actually not compromise on the rental reversion we were able to achieve in the assets. For the key markets of Bangalore and Hyderabad particularly, and also to a certain extent in Chennai, the market reversion was much higher. So the mark-to-market number was much higher than what was our in-place rent. So in the effort to achieve those higher rents, we were quite tight-fisted or I would say less lenient in letting go some of those upliftment opportunities. It would have been easier to get a higher occupancy in place if we had leased it at slightly lower rents than what we were achieving. But we made a very conscious choice that we want to take the full benefit of the upliftment of the in-place rent to the market. And notwithstanding maintaining 91% occupancy, we still achieved a fantastic number in terms of our DPU growth and our income growth. So that I would say I would request the members, the unit holders, to not look at occupancy in its isolation itself. Also look at, did we achieve the growth in income and the growth in NPI, even if we did not achieve the occupancy targets that we would have otherwise achieved. It's always easier. I mean, the asset managers that are there on the ground are always tempted to push, let us lease it to this tenant. He's asking for a 3%, 4% discount on pricing. He'll take it if you give it. We as portfolio managers and as investment fund managers, we hold tight and no, we take a call. No, I mean, no, this is income which you're going to lose out for the next 5, 6, 7, 8, 10 years. If you, lose that 2, 3%, it's not a 1 year loss. No, it is going to hit you every year. And also from a valuation perspective, you're going to lose something like a 10, 12 multiple. So for these two reasons, we are focusing on the rental reversion, and therefore we did take a slight hit on occupancy, which was particularly in two assets in Evans, Hinjewadi, and in ITPC in Chennai. Hinjewadi is a bit of a challenging market because the metro connectivity, or the MRT as we call in Singapore, is under construction. It is expected to go live. So in India, when infrastructure is upgraded, one of the quirks is that your existing infrastructure crumbles before you actually. So if you're making a 4-lane road, if you're constructing an MRT on a 4-lane road, you close one of the lanes for the construction. So what is a 4-lane chock-a-block road now is a 3-lane, even more chock-a-block. So till such time the MRT becomes operational. Hinjewadi is going through that phase. Now, we would expect Hinjewadi upliftment to happen largely in 2027. We do expect to close this year closer to the 70% mark for Evans 2. ITPC Chennai, that 85 should move to about 90% pretty soon. So that committed occupancy number should go up. But my request is also always look at that in conjunction with what the rental reversion we achieve.
Thank you so much for the clarification there. So the next question is about CLINT's data centers, where the community member asked for an update on the leasing status for CapitaLand DC ITPH, which is expected to be completed in the second quarter of 2026, as well as for CapitaLand DC Chennai, which is targeted for completion in the third quarter of 2026. Specifically, whether there are any anchor or potential tenants currently in discussions, or are these properties still in the marketing phase?
Great question. If I could just give you a little bit of context. Among the 3 data centers that we are developing, the Navi Mumbai Tower 1, Navi Mumbai market is a pure play hyperscale market. So hyperscalers are the kind of the FANG, as you call them, and they take up a lot more capacity, but they pay slightly lower rents. But hyperscalers, the leasing velocity to hyperscaler is quicker if they like you. Hyderabad is not a hyperscaler market. It's an enterprise market, as in the 27 megawatt IT load that we have here will get taken up in chunks of anywhere between 100, 500 kilowatts to 1 megawatt to 2 megawatts to 3 megawatts. So you're going to have multiple tenants using that 27 megawatt facility, as against, let's say, in Navi Mumbai, the 34 megawatt facility in Tower 1 fully leased up. Tower 2, 37 megawatt, fully leased to the same tenant. Tower 2 is not even complete. It's still under construction, but it's already pre-leased. So hyperscalers commit larger capacity. Chennai is a mix of both. It is hyperscale as well as enterprise demand. In terms of discussions, therefore, the traction that we'll have in Hyderabad and in Chennai is going to be slower than what it was in terms of Navi Mumbai. But that's the nature of the market. Navi Mumbai is 50-60% of India's market share in terms of DC capacity. The upside of that is that you will get better rentals in Hyderabad and Chennai because some of it is enterprise. Enterprise end up paying slightly more. In our underwriting models, we have underwritten something like a 30 months time frame for leasing these properties after completion. In line with that, we are having multiple discussions, especially in Hyderabad. We are having some very good discussions which can get signed up later this year, which will start the momentum for the leasing. But I don't expect both Hyderabad or Chennai to be reflective of what happened in Navi Mumbai, which is one hyperscaler just signing a couple of contracts and taking up the entire capacity. These other 2 markets are going to be a slow burn, but in terms of returns, they do stack up because you'll have slightly better rentals on those. And because these are smaller assets, hopefully you will lease them faster as well.
Thank you so much for the clarification there. So the next question is on CLINT's debt maturity profile. Particularly, the community member observed that there are slightly more than 510 million Singapore dollars worth of borrowings due for refinancing in the coming financial year 2026. And this represented the largest refinancing quantum over the next 5 financial years. The member asked for an update on the progress of the refinancing plans, including the timing as well as key considerations.
Great question. Almost 60% of this exposure is to revolver facilities, which are facilities which we dip into as and when we need it, on a short-term basis, and we deploy, and then we look at the long-term strategy of how to sort of convert them into a term loan. So this is but a slice and this is but at a particular point in time when it looks like this. We have already that $314 million of revolver facility has already come down by close to $40-50 million as we speak. And once we get our cash proceeds from the DCCL, some of that or all of that will go to immediately settle some of these. So the revolver facilities are strategic capital which we tap in for quick deployment. And from time to time, they will balloon up and then they'll be termed out and they get moved on. The other term facility is largely under control. A major chunk of that is going to come about in the end of the third and the beginning of the fourth quarter. So that is just going to be a standard refinancing. And from a cost perspective, it is going to be quite accretive as well because some of the rates that we entered into were in the high interest rate environment. And today, interest rates have since then softened. So it is going to be beneficial. Things are under control. Nothing to worry there. We also have significant cash, close to about 130 million plus, which is in India. If there are any immediate urgent requirements, we always have the option of paying withholding taxes or dividend distribution taxes in India and upstreaming that capital as well. So far, things are under control. We also established last year that we have different sources of capital. We can do onshore bond issuance, offshore bond issuance, perpetual. So we are not just subject to short-term or long-term bank facilities. We have other tools which we can tap into settling these facilities as and when they mature. So nothing to worry about right now. Markets are quite stable.
Thank you so much for the explanation there. So the fourth question is on DPU growth, where considering that it is denominated in Singapore dollars, while the underlying earnings are in Indian rupees, how does CLINT intend to increase the DPU in Singapore dollar terms, particularly given the depreciation of the Indian rupee against the Singapore dollar over the past decade, which could potentially negate or even erase growth at the Indian rupee level?
This I do need to acknowledge is a systemic issue which we have, which we have been trying to manage ever since we got listed in. Indian rupee does depreciate against global currencies, particularly against US dollar and Sing dollar, which is even becoming stronger. But there are various tools that are there, which kind of has protected us and which kind of has helped us negate some of this depreciation. The first of which is that the contracts in India, the lease contracts in India, have escalation clauses, which on an average is between 4 to 5% every year. So if you look at the depreciation of the currency, it ranges between 3%, 4%. Last year was quite high because of all the geopolitics and the tariff trade wars that are happening. That's an aberration. Otherwise, it's typically in that 3% to 4% mark if you take the last 10, 15 years. But we have rental growths which are contractual at 4 to 5%. So your income is definitely growing at least at the same pace, or if not slightly better than what the currency pressures are at. Plus, you have rental reversions when the market re-rates itself over and above the contractual rents, which acts as step-ups for us. So these are systemic benefits that we also have being operating in the Indian market. The second thing is in terms of how we operate the assets themselves. We from time to time we kind of improve the operations of the asset. We change the efficiency of the asset, and something which we have been doing quite successfully, which is kind of a little difficult to comprehend is um, the carpet area and the net leasable area, uh, uh, continue to change to our benefit every year. So let's say we had a carpet area of 100 square footage. When we lease it to a tenant, he starts by paying, he used to pay, let's say, 100 square foot rent of 100 square foot. But what we are going and telling the tenant of late is that, look, in our business parks, we have a host of amenities such as food courts, uh, 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 gymnasiums, childcare facilities, banking, ATM facilities, some little bit of grocery, no, a lot of amenities, no, open area, no, cafes. All of these are not actually very remunerative for us. The only reason we operate these spaces is because they benefit the employees that work for our tenants. So we are going back to the tenant and saying, because we are maintaining these areas on a non-remunerative basis, they need to share some of the load. So when we go and negotiate new leases with new tenants for the same carpet of 100, we are able to charge 108 to 110. And the reason we are able to get that is we say we are loading the amenity space onto the carpet area of the tenant. And that is something which we have been able to successfully implement whenever a new tenant comes in. Existing tenant, the contract says 100, you cannot change it. But for a new tenant, when we draw a new contract, the same 100 square foot space, we sign it up as 108. And they willingly agree, to the logic that we explain, and they're happy to pay rent. So not just your contractual rent escalation, not just your market rental growth, but also in terms of your NLA growth, even without actually putting one single brick extra, you're able to charge a slightly higher square footage. So we come up with these operational efficiencies from time to time, which kind of makes up for some of those exchange rate losses. And the other thing is we always try to buy assets at a discount to market. We never ever go and compete with other institutions for a product in the market, no matter how attractive it is. That's the reason why there are a couple of assets which went to the market from so from some of the private funds managed by CapitaLand. We participated, but we did not we did not put in a very aggressive bid because the aggressive bid was not accretive to our unit holders. So therefore, we don't participate as much in the open market bidding process. How we actually benefit is by the forward purchase program, wherein I said we catch hold of a developer who doesn't have too much of commercial office or business park experience. We tell him that we'll help him design the best business park. We'll fund the construction through a financing loan. We'll help him lease it. And because we help him do all of this, we we request him to sell it to us at a discount to market price. And the discount is 15 to 20%. So we are buying a similar asset from the market at closer to the 10% yield when our competition is buying at an 8% yield. So that additional 2 percentage points helps us circumvent or offset some of the losses we come from get it from the currency part. And the third, which we are actively doing now, is onshoring a lot of our debt to India, wherein at least on the debt side, we want to have a natural hedge. So part of the balance sheet, even if the equity portion is still exposed, the debt portion has a natural hedge. So that will continue to improve this further. And last but not least is on the income side, we do take hedges in the market on a rolling basis. Typically it is 3-6 plus months rollover hedges that we take so that there are no immediate surprises in the market if the currency kind of depreciates. So it is a mix of systemic benefits that we have in India, efforts we put in. We really work hard to ensure we beat the currency depreciation and also some of the financial structuring that we do. We believe with all of these three, we will be able to generate, like I said, 5, 6, 7% increase in DPU despite the currency depreciating between 3 to 4% on a long-term basis.
Well, thank you so much for the really, really detailed explanation on DPU. I think the community members will really, really appreciate that. So the final question that we have here is a general one, where the community member asked about the shifts that are being observed in India's consumption patterns and industrial landscape. And how does CLINT's management intend to adopt this tenancy strategy in response to these changes?
I break it up into two parts. So India is growing at a quick click. It is in the 7% mark, no plus or minus. No, sometimes it touches 8, sometimes it goes down to mid 6%. For next year, the budget was presented just a week back. It is pegged at 10% nominal, and if you take inflation 3% range or 3.5%, it's about 6.5, 7%. Real growth is expected. Last year, particularly when the tariff wars are going on and consumption was a bit soft in India, India did cut quite a bit of indirect taxes and gave direct tax benefits, putting more money into the pockets of the people to improve the consumption of the population. So that really did help the market. And now with the tariffs, war kind of settling in with the trade agreement coming in place, things should get back to they're moving back into a slightly more uh, less incentives or less money or less capital towards incentives and more capital towards capital expenditure and larger capex. So government has put in close to, I think, 12.2 trillion Indian rupees, in terms of capital investments in infrastructure. And those infrastructure investments are going to happen in roadways, in railways, in defense, in waterways. So there are a bunch of benefits, and there are a lot of incentives, that has been offered for the hyperscalers, who operate cloud services from data centers which are located in India. So all of these are going to have a medium to long term impact in our industry, particularly in the commercial office space, in the data center, and the industrial and logistics space, pretty much equally. The tariff war ending, things settling down. There was always this, the service sector was under a little bit of pressure, even though it did not have any tariffs. So there will be more traction in terms of leasing. A lot of global capability centers were setting up shop in India over the last 2, 3 years. Close to 40% of the direct demand, and if you include indirect demand through managed office spaces, they were taking up close to 55, 60% of the total market share of the business park space, the IT office space in India. So that trend is expected to continue. 2025 was a record year for leasing. Close to 80 to 83 million square feet of space was leased in India. In comparison, in Singapore, which was a record year, which was 2025 was 2x of what was in 2024. I think it was 1.3 million square feet of office space was observed. As against that, India had something like an order of 80. It was 80 multiple of that number. So that's this difference in scale. And the product is very similar. No, I mean, you would have to be in India to see the grade A product that is coming on board is very similar. It is an aspirational crowd. They want a lot of amenities. The focus is there on sustainability. We do use a lot of green energy in whatever assets that we are developing, and even when we acquire assets, we try to enter into power purchase agreements from renewable service providers to improve our green credentials. And the demand that is there is continuing to grow across the business park space. Industrial space was industrial slash logistics space, because of the trade war last year, was a little bit softer because I mean, scouting was happening, but they wouldn't sign the document or take up a space because they weren't sure how the trade war that was happening between India and US would end. Now that the trade agreement is signed and there is clarity on what the tariffs are going to be, and there is expectation of peace to prevail in the medium term, the signings of industrial facilities and logistics should continue to improve. And in terms of data center, and this is a statistic which I keep telling wherever I go, India's data center capacity today is roughly 1 megawatt per million people. Singapore's capacity is 220 megawatts per million people. So India has to grow, at least, even if it grows by 4x times, it'll still be orders of magnitude lower than where Singapore is. Even forget Singapore. If you compare US is 52 megawatts per million. Europe is between 10 to 12 megawatts per million, and India is just about one. It is way behind the curve in terms of how much data center capacity it has. India does produce close to 20% plus of the global digital content gets produced in India, but the storage is only about 2 to 3%. So the data center, and they have incentivized, they have said they've come up with cloud players that set up cloud services in India for in Indian data centers for global consumption are going to get a tax-free regime till 2047. For the next 21 years, they don't need to pay any taxes if they are running those cloud service from Indian data centers. So that's a huge incentive, which is expected to improve demand further. So far things are really good. Like I said, the only things that could derail are more geopolitics, some electoral issues that happen. If it's been a very stable government for the last 3 terms, we have another 3 to 4 years to go, so nothing to worry. But any state level elections which throw some surprises, or the currency fluctuations I mean, these are things which are not necessarily in our control, which could throw a spanner in the works. But otherwise, it's very, very stable growth that we expect from within our portfolio, and from the industry in India as well.
Thank you so much for the really detailed explanation. Looks like we are going to see a lot of very good opportunities in India in the coming years ahead. So
Yeah, I'm
that's
looking forward to that.
yeah. So that's all the questions we have today. Thank you so much to everyone who has submitted them, and also to you, Gauri, for your patience in responding to each and every one of them and doing it so with so much detail. And I'm sure the community members will really appreciate it. So with that, we have
I
come. Yeah.
Thanks so much, Jinuan. I really appreciate you taking that time, as a retail investor in gathering up these questions. And I actually would want to individually thank all those that took that time to study us and come up with these questions. We really appreciate the effort they put in, and I really want to say that the management always thinks about how we can give better returns to our investors. We're just not catering to institutional investors. We have a very, very large retail investor base. Unfortunately, the opportunities for us to engage with them is much, much smaller than with institutional investors. I wish we could do more of these, meet them in person and try to explain what our story is, and answer their questions. They will have a lot of questions, particularly because these are assets which are, like you said, they can't go touch and feel or see these assets. They are remote. It's still just about a 3 hour flight, but nevertheless, these are assets it's in the developing world. I do appreciate, therefore, you taking the time today to collate these questions and give us one opportunity to present our case. And I just wanted to use this and reiterate that we are ultra focused on dividend growth. We'll do everything we can to get that DPU going as high as it can, and we really want to be among the best performing S-REIT units there is.
Definitely will be. Yeah. And I'm really, really confident of the business trust growth in the coming years ahead. So with that, we have come.
Thanks.
Yeah. Thank you so much for everything, Gauri. I really, really appreciate it from the bottom of my heart. And thank you so much for giving me the chance to have the opportunity to do this today. I
Thank
greatly,
you.
really,
Thank you.
really
Really
appreciate
appreciate it.
it.
Really
Yeah.
appreciate
With that, we have come to the end of the presentation as well as the Q&A session. And I hope everyone who is watching this video will have a much better understanding of CLINT after watching this entire video. So for those of you who have any other questions, please feel free to reach out to CLINT's Investors Relations team. I'm sure they will be more than happy to answer any questions that you may have.
it. Absolutely. Thank you so much. Please
Thank you.
always reach out to us. We're more than happy to answer the questions.
And once again, I would
Thank you.
like to express my deepest gratitude to you, Gauri, for your time to join us in today's corporate highlight video series today. And I really look forward to doing another one together sometime soon. Yeah.
soon. More good
Yeah.
news. Thanks.
Thank you. Thank you. With that, goodbye and have a
Bye-bye.
great rest of the day ahead. Goodbye.
Yeah, happy New Year as well.
Yeah, thank you so much. Happy holidays to you too.